I'm sure you agree with me that we have watched numerous videos about market crash 2021. Is it going to happen, or will the market crash in 2022? Or are we going to enter bear market? Guess what? It all happened, and it happened in front of our eyes. I mean, from raging bull market to months of sell-off to now some call it as a bear market, it all happened while we denied all along. And now the latest word I'm seeing thrown around is recession. So are we going to enter recession, or are we already in the beginning of it? Let's hold that thought and let's talk about something else for a second. So we all can agree that we are dealing with a lot of issues, from Fed to inflation to Russia, and looks like all forces are combined together to make our investment disappear even faster every day. I mean, when we have folks like Warren Buffett and Charlie Munger giving warnings, then you know things are getting real. Now, I'm not an economist, but when you see reports from different sources that say the same thing, then you have to start thinking about what you can do to take advantage of the situation, well, if there is anything that's left to do. I have seen all my gains disappear in front of my own eyes, and I could not do anything. And now they're evaporating even more. So what I can do is share what I see and maybe in the process somehow help prepare for what's coming. I have talked about recession in my past video, but I saw another source that talked about recession, and in today's video, let me explain recession at a much simpler level. So before I explain you this very simple image that's on your screen right here, just a quick background on recession. So recession lasts about 1 year. During that, the GDP of a country drops about 2 to 5%. And we call it a country in recession if GDP declined for 2 consecutive quarters or for 6 months. So if the GDP has continued to decline for the past 6 months, we can call that country in recession. Another thing to note that between 1960 and 2007, there were 122 recessions across the world. So some of us have lived in those times, and if you played smart, then you could have come out stronger after the recession. So now let me explain this very simple image that you see on your screen. So in recession, there are 3 main components. Of course, there is unemployment, there is also the whole inflation, everything is kind of taken in account, but there were 3 important legs in a recession: interest rates, inflation, and consumer confidence. All these 3 things combined kind of give us a very short picture if the country is headed into recession or if the country is already in recession. So if you pay attention here, we have first interest rate, which we know are going to go up. When interest rate goes up, people do not spend money because they are getting better return for their money into the bank accounts because they are making more money by depositing their money into the bank. But that's also another negative of this, is that because people are now have to pay higher interest rate, they borrow less. When they borrow less, the money in the circulation decreases, or the money that's out there decreases. Because people are not, they want to put money in their savings account because they're getting a good interest rate instead of investing in stock market, or even though they get like 2% return, they'll be like, it's better and it's safer, at least I'm getting 2% return instead of losing it all if I put it in the stock market. Then on top, people, those who are going out to get loans, maybe it's personal loan, maybe it's car loan, maybe it's house loan, they delay it because they feel like, you know what, they are paying really high interest rate, they cannot afford the payments, so they will wait to buy the house, to buy the car, or to add an extension to their house, or whatever the reason is. That leads to less money in the circulation and less money in the economy. Second point, inflation. We know what inflation does. It forces people not to spend money because money that they need to spend goes into necessities. Food, they have to eat. Home, they have to pay their mortgage. Or gas, they have to fill in their tanks to go to work. So all that thing causes people to spend less money onto the things that are not important. So businesses receive less cash. Now they are getting better interest rate. So business does not spend in their own growth because they feel like, you know what, we are not selling that much product. Why bother adding another factory? So they put that money in the savings account. That means less money in the circulation. The third most important point is consumer confidence. Consumer confidence is very tricky to measure, and of course it changes very quickly. So the only thing that I would say is the most uncertain in all of this, because we know that we are going to get higher interest rate. We know inflation is at 40-year high. The only thing which is most uncertain right now is consumer confidence. And of course, right now, consumer confidence is really down. As you can see, the stock market is suffering. Everybody feels that, you know, we are not going to make any money. 2022 is going to be a wash, and we can end up actually losing our savings. And right now, if you see 2022, we have lost a lot of our savings. Some of our portfolios are down 30-40%, which is insane. So on that, let me share an article that shows the consumer, or what consumers are doing and how they're thinking. So this article right now that I'm going to share with you mentions 2 very important things, and I'm going to read that out to you. So pay attention to this. Weekly inflows to US Treasuries at 7.4 billion were the highest since March 2020. So what happens? When markets are uncertain, when consumers' confidence goes down, they tend to flock or they tend to fly towards more safer investment. And bonds are safer investment as compared to stocks because they have limited return, but they have limited risk. So people tend to put their money into the bonds, into the government secured securities because they are much safer. So they're saying that Bloomberg is reporting that Bank of America strategists saw US Treasuries at 7.4 billion inflow. This was the highest since March of 2020. See, in March of 2020, when the stock market went down, everybody was just flying to these bonds because they didn't know if the stock market is going to completely going down to zero. So then after that, meanwhile, cumulative 4-week outflow from TIPS, which is Treasury inflated protected securities, total 7 billion, while the cumulative 17.5 billion exited high yield. So these two numbers are really critical. That means right here, both figures were the highest since April of 2020. So the combination of inflows to treasuries and dumping of TIPS and credit indicates recession risk, according to Bank of America. So this, you don't have to be a genius to understand this. When people are not investing in stock market, we saw what's going on with the stock market. There are more outflows than inflows. Then you know that people are scared. Consumer confidence is at all-time low right now. People are scared. They feel that this is not safe. The equities or share market is not safe, including folks, those who have been in the market for a very long time. I have been investing since 2008, and I have never been in a situation where I felt scared going into the market, and I am right now, because I feel anything I will touch will ultimately going to go down more. So again, everybody says you cannot time the market. We all have heard it, but we like to time the market. That's human nature. You don't want to buy something here and then 2 weeks later the thing is over here and you feel, I'm not going to time the market. It's all good. Yeah, it's all good. But if it continues to drop, then you start to question yourself that you could have waited, you should have waited, and then could have, should have is the worst thing you can have in the markets. So I feel right now consumer confidence is shaken. It's really, really bad. And that's why what we see in the markets right now, as more and more outflows are happening for the TIPS, which is Treasury inflated protected securities, and people are actually flocking towards US Treasuries or bonds because they are much safer. Now, along with that, take a look over here. So equity saw weekly inflows of 2.2 billion, which flows into the tech 0.7 billion being highest in 5 weeks. Only last 5 weeks, people started to basically feel that, you know what, this could be the bottom. This could be the bottom where we can enter the market. I also bought some Tesla. I actually alerted in my Discord and Patreon saying that, you know what, I'm buying Tesla because I feel this is a really good price. I think it was like 847 or something like that. So it's really good to see that there are some securities, there are some equities where people are feeling confident saying that this is the bottom. But again, nobody knows, and as nobody can time the market. And if we are entering recession, that's going to go down not good for securities, especially for equities, especially for high growth companies. Doesn't matter if it's value or not value, we are going to see more pain as in the coming months. Along with that, if you pay attention over here, gold has the 6th consecutive week of inflows, 0.4 billion, because as soon as we had this recession fear or market crash, people fly to more safer investment. Bonds, gold is more safer, and that's why you saw over here that we have 0.4 billion. And then another sign of consumer confidence. Now you saw that, right? Over here it says inflows of US Treasury 7.4 billion. Check this out. Bonds saw their highest redemption since March 2021 with outflows of 11.8 billion, cash outflows of 79.4 billion. So people are cashing out, even though some of them are going in and buying bonds because they have so much money lying around. They don't want to put it in the bank. But majority of the people, or most of the people I should say, are basically taking the money and they are saving in cash because they don't know what to expect in the coming months. So now let me explain my take on how market is going to play out. Again, completely my take. I'm not an economist, but this is what I think. Fed raises rates, but now it's too late. The housing frenzy that started in 2020 will continue in 2021. And people started to buy houses at low interest rate, and they will still continue until interest rate goes up, which they have already started. Supply chain caused new housing to stop. So the demand is there, but supply is limited. So people continue to overpay for houses all year. But it's all well and good because their monthly payments are low because of the interest rate. And why not live in a nice house? There comes 2023. I'm not talking about 2022 here. I'm talking about 2023. There comes 2023. Now the supply chain eases and Fed has raised the interest rate high enough where the mortgages are not cheap anymore. Now, the housing prices will start to come down, but folks who bought the houses thinking that they will be there for 10 years realize that housing is about to crash and they should sell, and then comes the chicken and egg situation. They cannot sell because the folks buying cannot afford the payments, interest rates are higher, we are in recession, and equities and share market is in turmoil, and folks are not making much money. And of course, because of stock market is struggling as well, their confidence is really, really low. And that's why folks come out and they sell for cheaper than what they bought for, or will just default. So even though the market may rally towards the end of 2022, but the dollar will be weaker because of all the money that we have printed and all the things we have done to come out of 2022. This is getting interesting and changing the dynamics of investing, because I am now thinking about the options for 2023 and 2024, which we bought thinking we have enough time. Maybe that's not the case. I just read this whole report and I will continue to dig deeper and will share with everyone every step of the way. So if you enjoy content like this, then subscribe to the channel and hit the like button. And for more one-on-one conversations and also for trade alerts, consider joining our Discord and Patreon mentioned below. As always, a pleasure to share all of this with you. Until next time, you all have a sparkling day.